Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. In this week's video, we'll go over the book Poor Charlie's Almanack by Charlie Munger. I highly recommend that you read this entire book, which I'll link to down below. Munger is one of the world's wealthiest business people. Although he's known for his humbleness and dedication to his sound investing principles, it's not often that you hear from an investor who stands by his values, from requiring honest financial reporting and refusing to hide his money in tax havens. In this video, we'll be going over Charlie Munger's early life, Munger's career transition to ethical investing, and Charlie's mental models for investing. Munger's early life. When Munger was young, he worked at a grocery store for Warren Buffett's grandfather, but it wasn't a typical summer job. Munger was ordered to work 12-hour stints with no breaks and was paid a measly $2 per hour. While it was a tough experience, it developed a work ethic that he would maintain throughout his life and later instill in his children. As a child, Munger faced firsthand the hardships of poverty during the Great Depression. As a result, he has always made an effort to contribute to society. With his wife Nancy, he has provided large contributions to colleges and hospitals. He's also a strong supporter of causes he cares about. Giving back, according to Munger, is equally as important as working hard. Munger's academic career began with intense study at an early age. In fact, his parents encouraged their children to read and regularly gave them books as presents. Later, Munger decided to follow a new passion when it came time to enter college at the University of Michigan Mathematics. He later opted to study physics, which he says was vital to his success since it taught him how to solve complicated issues using logical reasoning. However, he was unable to finish his studies, which were put on hold during World War II when he was assigned to the University of New Mexico to study science and engineering in preparation for a career as a pilot. After serving as an officer in the Army Air Corps, Munger was dismissed from the service in 1946. Munger was later accepted to Harvard Law School because a family friend, who was a dean there at the time, intervened on his behalf. He was able to finish magna cum laude, one of the highest achieving students in his class. Munger became very wealthy after graduating from Harvard and joining a legal practice in California. Yet, he was dissatisfied with his legal profession. He yearned for more money, more power, and more chances to put his skills and knowledge to good use. Munger's career transition to ethical investing. In 1959, shortly after his father's death, he chose to return to Omaha to settle his father's estate. Warren Buffett, who was already a success within the realms of business and investment at the age of 29, was invited to a dinner organized by some family friends. After an evening discussing business, money, and history, Munger believed that he had finally encountered someone at the same level of intellect. This prompted the beginning of more than 60 years of partnership. Buffett persuaded Munger that his abilities would be better suited in finance and investment. In 1965, Munger resigned from his legal firm, creating his own investment firm with a friend. In time, Munger would ultimately join Buffett in the running of Berkshire Hathaway, resulting in the company's stellar performance and earning it a position as one of the world's most recognized investment businesses. Munger's physics and math background helped him to solve problems, and his legal knowledge gives him respect for the law and attention to detail required to operate an honorable and principled business. While Berkshire Hathaway is massive with over 175,000 employees, there have been relatively few scandals or lawsuits from such a large firm. Actions such as insider trading and manipulating financial records to make investments look healthier are not uncommon in large firms, but Munger refuses to take part in them. But the temptation is strong. Investment managers are under tremendous pressure to show that they bring value to their customers' money, and Many investors use illegal shortcuts to get around this. In case of tax avoidance, this is also true. In this age of global trade, companies like Amazon continuously try to avoid paying taxes by placing their headquarters in tax havens such as Dublin or the British Virgin Islands. Munger despises these socially acceptable forms of criminal behavior. Berkshire Hathaway stockholders and workers are strongly urged not to enter murky areas of the law and to conduct themselves in a moral manner. The business takes pride in paying all of its taxes, and Berkshire Hathaway has mainly retained its good reputation as a result of this ideology. Munger's ethical business approach has grown even more famous in the aftermath of the 2008 global financial crisis. He was speaking out loudly against accountants who used creative accounting to falsify their customers' financial records even before the catastrophe. Of course, this turned out to be astonishingly accurate. People were unable to repay their debts when the financial crisis hit. Since house prices fell, after derivatives were proved to be practically worthless, the market fell like a house of cards. Of course, Berkshire Hathaway was one of the few firms to emerge unscathed. It turned out that resisting the pull of creative accounting was not just moral, but also financially sensible. Munger's appreciation of transparency is also portrayed in a detail that he likes to recount of a finance officer at one of his businesses who made a large investment error. As soon as he realized what he'd done, the officer hurried to the company's president to confess. The president agreed that this was a terrible oversight and recommended that the CFO to be more cautious in the future. However, he kept his job, since he quickly admitted his guilt rather than attempting to hide it. Munger's honesty policy is encapsulated in this incident. While he has no patience for liars, he is realistic when it comes to making errors. Mistakes, he says, are unavoidable in life. What counts is that you take ownership of your errors and learn from them. Munger is also a big believer in living what he teaches. Having admitted to several severe blunders over his career, errors of omission, such as failing to pounce on a potential investment opportunity or not acquiring enough shares, having been some of his most major financial missteps. For example, Berkshire Hathaway passed down an investment opportunity in Walmart because the stock was too pricey. As a result, they lost billions of dollars. It's a basic human impulse to try and hide a mistake. Refusing to recognize mistakes that we make might appear to be a sign of weakness or insecurity, but only the most confident people can easily confess when they've made a mistake. Along with his principled business practices, a reason for Munger's success is his belief in sit-on-your-ass investing, which means that one of the most critical attributes for a successful investor is patience. He and Buffett look for good investment opportunities in discounted stocks in firms that they feel will become lucrative in the future. When they discover a good deal, they acquire it immediately and often hold on to stocks for decades. This wait-and-see approach may not be as exciting or nerve-wracking as some other competitors' investing techniques, but it has proven to be quite rewarding. For instance, following the 1987 stock market crash, Munger and Buffett recognized a chance to acquire Coca-Cola shares at a low price. They understood that despite the price decline, Coca-Cola was a stable firm with great brand awareness, and that the price would eventually return. After a $1.3 billion investment, Berkshire Hathaway became the company's largest stakeholder. Their faith in business paid off. Those shares now worth $8 billion. Some investors argue that Berkshire Hathaway could have instead diversified by investing a lesser amount in a larger variety of firms, which is a method used by many investors. They would have been able to rely on other investments if Coca-Cola had gone bankrupt. However, Berkshire Hathaway favors quality above quantity. They prefer to purchase a majority stake in a smaller number of companies by investing in fewer of them, giving them far more control over their futures and bigger payouts later on. Another strong piece of advice by Munger and a reason for his grand success is that investors need multiple tools or ways of approaching a problem. Otherwise, they'll suffer in the long run. You'll need a diversified range of tools taken from several fields to be successful, providing you the mental sharpness that you need to adapt your problem solving and thinking to different situations. This is also reflected in the fact that many educational institutes only provide you with training in one field. However, as Munger argues, this isn't a good education. Instead, we can look to pilot training for a good education model. Pilots must be able to think outside of the box and react swiftly and efficiently to challenges. When it comes to flying a plane, relying solely on one solution might be disastrous. Pilots are not only taught theory, but they're also taught to demonstrate mastery of the curriculum by putting what they've learned into practice. Simply passing an exam isn't enough. Pilots also go through checklist procedures, mentally cataloging problems and their probable causes or solutions, even if they don't think that they're likely to happen. This technique enhances the mental agility by challenging pilots to explore different options. Aspiring investors who approach their schooling in this way by drawing on diverse knowledge and with continuous practice applying it would be considerably more effective at thinking and making judgments based on complicated situations. Understanding psychology is truly essential, and so is being aware of the limitations of your own thinking. To do this, Munger suggests using a two-track analysis when investing to overcome your own psychological limits. Begin by taking a step back and analyzing all of the facts about an investment logically, and ask questions like, what are the dangers and possible benefits of investing in the company? Consider any psychological variables that might be at play, which may be unconsciously affecting your decision. For example, are you enticed by the management of the company because they flatter you, or do you have any negative feelings towards them which could cloud your judgment and cause you to pass up a financially lucrative opportunity? As an investor, even knowing what you don't know can even give you an edge over others. For example, Munger and Buffett use a circle of competence mindset to decide whether or not they are competent enough to make an investment decision. Because they lack knowledge of the field, they refuse to invest in high-tech sectors, such as computers and internet-based products. This way, they've avoided any potential disastrous losses by making decisions about things you don't know much about. I encourage you to check out a video on my channel called Charlie's 24 Cases of Human Misjudgment that gives a glimpse of how broad of a thinker Munger is. But what makes a good business to invest in anyway? According to Munger, there are a few key points to keep in mind. Management is very crucial because a smart manager can turn a failing firm around. Another crucial thing is to evaluate the market position of a company. Coca-Cola and Gillette razors, for example, have unequaled brand awareness and expansive global distribution networks. Gillette also has the financial means to invest in cutting-edge technologies, ensuring its competitive edge. Good management and a favorable product nearly always guarantees a good investment. I highly encourage you to read the entire Poor Charlie's Almanack book, but to summarize, number one, good investors know how important it is to keep a level head while waiting for the proper investment opportunity to come along. Number two, Munger prefers to have a few high-quality assets you're keen to stay with for a very long time, rather than having hundreds of low-quality investments. Number three, it's also important to live by your moral and ethical convictions to be a principled investor. This is not just a moral, but also a financially sound strategy. What's your favorite Mungerism? Does Munger have any other advice you admire? Let me know in the comments below. Thank you so much for watching, and if you like this video, please share it with your friends and family. It helps the channel a great deal. Leave in the comments section your thoughts about the video and who I should cover next. With that said, thank you guys so much for watching this video, and I'll see you in the next one.